Good morning, all, and welcome to our 8th in the room webinar series. Today, I'm joined by Rob Johnson. I'm from Nedgroup Investments. Welcome, Rob.
Thank you very much for having me. Good morning.
Yeah, that'll be good. So I think today, Rob and I will be very much chatting about the Nedgroup Investments kind of best of breed investment approach. And how they go about selecting investment managers at Nedgroup. And again, I think importantly, the idea of today is very much how you as wealth managers can then kind of take that back to your business in terms of how you look at kind of investment managers. Before we get going, just the normal kind of couple of house rules. So I think everyone who's been part of this before will know it's an hour webinar. We stick to the hour. That's very important. It's an interactive session, so literally it's Rob and I chatting, and we very much welcome and encourage you to ask us questions via the Q&A tab at the bottom of your Zoom page, and then what I'll do is Rob and I'll probably chat for 20-25 minutes, and we'll bring in some questions, pose your questions to Rob, and then we'll carry on from there. It's just from a CPD point of view, which is always important. If you attend the majority of the webinar, it's around 90% or so of the webinar, then you do receive your CPD certificate directly. If you can't, for whatever reason, then you are able to watch the recording, which we'll send out to you, and then there's a short assessment for you to receive your CPD certificate. Cool, and then that's about it from the house rules. So to get going, Rob, you're clearly not from South Africa. Maybe just the audience can get to know you. What brought you to our shores?
Yeah, that's true, and it was quite painful being an Englishman in South Africa last November. But let's probably park that conversation for another day. My wife's South African, and as much as I love the British weather and trudging into London an hour and 45 minutes either way, I was very keen to get to South Africa and come and experience the lifestyle and culture here. And I've always loved the place ever since we've been together and visiting South Africa. And it's just, I find the scenery, the people, the lifestyle incredible here. And it was a real draw. And I happened to start up a conversation with Nick Andrew, who's the MD of Nedgroup Investments, and we got on really well. And I really liked the culture of the business, and managed to convince him that I was the right person to help with the best of breed process and with my fund selector experience.
Great. It's funny. It's whenever one chats to someone who's not from South Africa, it's exactly the lifestyle is almost, there's nowhere else in the world that you get a lifestyle like we have. But it's something for us locals to always remember.
Yeah,
I think.
We had a team call yesterday, and everybody was talking about where they'd been last week for a short break, and I was comparing it to visits to Brighton, and it's not really comparable.
Yeah, no. Okay, cool. So then getting into the real session. So I mean, I think first off, how would you describe kind of the best of breed approach? How would you kind of, just for in the layman's terms, in terms of how you guys put it together?
Yeah, sure. I mean, we have a very firm view that it's difficult for one investment house to hold all the cards or to be the best or the expert in a particular asset class or strategy. So, back in 2003, where the idea was incepted, then the view was that if we could outsource the portfolio management of our funds to independent majority boutiques, we thought we would gain some of the aspects that we believe drive investment managers to perform well for their end investors into each of our strategies. And that was irrespective of the asset class or the strategy that we talk about. And we think, there's a few key things that help align the interests of managers and their end investors. And one of those is being completely autonomous. So being able to invest the way they want to, having no shackles, having no link to an organization that might try and sway them one way or another. And it happens all the time. We don't tend to see that as investors. But we think it's very important. And if they're in control of their own destiny, then they can decide which mandates how big to become, how quickly they become big, how they run their strategies for the end investors. And that independence allows them to remain focused on the strategies that they're good at. Where a lot of the time, you find managers branching out into adding in a bit of fixed income or maybe launching a strategy that's just focused on a particular equity sector, or maybe even going overseas and looking on adding global in or adding a global strategy to their and that takes focus away from the original strategy that you've that you've desired to partner with. And that all of that brought together brings a keen alignment of interest with the end investor. And I have mentioned that a few times now, but that I think is key, because you have to remember that you're caretaking someone else's money. They've allowed you to do that, not you've allowed them to invest with you. I think you watch things like Billions on TV and these big hedge funds, you're allowed to be an investor. It doesn't work like that. It's the client has allowed you to look after their money for a period of time. And so you have to be a good steward of their capital. You
mentioned boutiques. And if you look at, particularly on the local side, you look at kind of the guys you've partnered with. They mostly are boutiques. You've got very few kind of big house names in there. And again, is that very much because of kind of that autonomy and aligning focus, kind of manager owned, or is it just by default you just like what those guys have done?
No, it's very much the former that you said. I think there's if you're have an ownership interest in the success of your business, and as a manager, the success of your business is driven by the success of your investors. So if there's no other sources of earnings for that business, so as one of the larger managers, you've probably got a number of different strategies run by different investment managers who might be firing at any one point in time, and you can fall back on that. If you don't have that, but you live or die by what you're producing for your end investors month in, month out, then you can imagine how keenly focused you are on the success and making that work. And you tend to find that these managers live and breathe investing. And that's one of the key attributes of a strong PM. You think, their interest in it, it's not just something they do for a job. It's something that they really believe in and find incredibly interesting.
And what risks does that bring with it? Because obviously, often what we get told is kind of the larger managers is they've got the size of the team,
mm-hmm.
they got the balance sheet behind them, they got the resources, but a kind of a smaller guy might not necessarily have that.
No, that's completely correct, and we've experienced that a couple of times in recent past, and that's one of the times that you may look to change a manager, or we may look to change a manager, and corporate action or a corporate event that affects the group is something that's a big challenge for the investment team, because then they start to think about, well, how am I going to focus on running money when I need to worry about whether I can survive or not? And it is something you need to watch. You need to be there's long periods of underperformance, that generally strategies do come across periods of long underperformance if they've got a particular style. And you have to sit through that, and you have to be able to withstand that. And again, it's that balance between being resolute to the way you invest, to being flexible and being able to adapt to the environment that we're seeing at any point in time. But that, coming back to your question, really is, yes, it is a risk. It's something that we pay a lot of attention to. We, as I mentioned, we had Electus, who are the manager of our growth fund. We had to change them this year. They decided to close their doors after many years running the portfolio for us. 19 years running the fund for us. Unfortunately, they weren't. They had a poor period of performance because mid and small caps weren't the flavour of the month in the SA market, and so that suffered for their strategy, and therefore they said, let's close the doors before we're forced to close. And that's something we monitor extensively, and also we have to have a backup. So for each of our managers, we constantly seeing different managers around the world, whether that be new boutiques, whether that be hedge fund managers who might have a long only strategy that people don't know about. It might be sub teams of larger teams at various houses. We have to look everywhere to uncover the potential backups if something like this were to happen.
Yeah, and then saying it, I often like to ask, but it's slightly different to ask you. Are there any kind of cases where you feel you've got it wrong? So you've gone and you've chosen a manager, but actually in hindsight, or you've just stuck with the manager for a period of time, but in hindsight, you kind of go, oof, we got that wrong. And if that's the case, kind of what lessons did you learn from that?
That's a great question. I think the one key lesson that I've always found where I have got it wrong, is where the manager changes their rhetoric through time. And so, but you can't see that in your original analysis, right? It's really difficult. So you can read commentary going back since the strategy started and see how that ties in with the performance of the fund and what was going on in the market at that point in time. But then you say, if that all ties together, then you might make the decision to invest. But then over time, as you listen to the manager and they say, okay, no, we believed in this area of the market, and then they come back 3 months later or 6 months later or 12 months and say, well, that's not exactly what we meant. And we were looking at them, and perhaps that was something we missed. And it's a combination of them questioning themselves. So they're questioning their own previous judgment, but also maybe trying to change the story after the fact. And that's always been for me one of the key signs of concern when you think you've got it wrong with managers. The other one I think we chatted about yesterday, there's there's long periods of time, and now we're into this growth versus value debate all over the world. There's long periods of time where a particular style or strategy underperforms, and you have to be convinced that still has validity into the future, or the manager has the flexibility and the humility to see that he needs to change the way they're approaching their investment challenge. And I think, again, that's one of the key elements we look for is a manager always going back on his investment decisions, checking whether he still thinks the thesis are correct, what they did wrong, whether they are able to cut some businesses that they got wrong. And because that's a really hard thing for a fund manager to do. And I'm sure a lot of people have invested in companies themselves where they say, well, I bought Vodafone. My friend works at Vodafone in the UK, and I bought Vodafone when he told me, no, they're committed to paying the dividend, and I'm still suffering from that decision now. And I'm holding on to it, And whereas, should I now be thinking, well, as we sit now, is this thesis still right? Are they still going to pay the dividend into the future? managers suffer from this as well.
So I mean, it's a key thing again, because if you're a wealth manager, and the reality is, and you are choosing your own portfolios, and that where you get your information from is going to a roadshow, a webinar, reading the fund fact sheets, the reports that the guys kind of send out. But you're saying is that the key kind of almost message there for a wealth manager is to look for that consistency of message and process. That's the key message. Am I right in saying that?
Yeah, exactly. And a really good trigger you can look for is if a fund manager buys something and then sells it within 6 months, and they've always told you they're a long-term manager, then you can pick holes and say, what's happening here? So there could be valid reasons for it,
yes.
but you want to hear those, and you want to ask those questions and see how they respond. Because obviously something's changed in their expectations, either good or bad. So it might have performed really well, and so they're taking profits, and it's already hit their upside, or vice versa. They've capitulated maybe within 6 months, and that's so it's always good to poke holes and test where there's decisions that you see coming through the portfolio that aren't in line with what they've told you how they run money. It's not easy. Because also, I think the last thing for you guys is that you've got a team of investment professionals, and you actually are able to engage on a one-on-one basis, look the portfolio managers in the eyes and ask them these questions. Where a wealth manager, it's not as easy, because it's either, as I said, other end of the screen or at a roadshow or something like that. But as you said, the consistency of the message is very, very important. Yeah, transparency's got a lot better, though. I think it's one thing that responsible investing brings to the party is that element of transparency. You can't you hide your portfolio away anymore. I mean, there's tools out there to look at the portfolios. You can phone up the client services and ask for the portfolio. Our portfolios are available on our website, so I'm sure a lot of managers make them available. And even if you're looking back through time, so it doesn't mean you need the portfolio from today. You can have the portfolio from 3 months ago, and you can compare that to the previous one and see what changes they've made, and you can tie it into something you remember from the news flow or the company, the websites that you follow, that gives you an idea of, oh well, I saw that happen. Why did you take that decision at that point in time? And what our client services, and I assume this is the same for a lot of firms, is that they will pass that message. If they can't answer that question for you, they will pass it on to the investment teams, and the investment teams will tend to come back to you. Yeah.
So you talk about transparency, and it almost makes me think about kind of governance, and then the ESG, and again, how, and it's funny, as our team on the NA platform side, we're starting to get a lot more questions about ESG. So it's, and I kind of, if I look back a year or so ago, it almost felt like ESG wasn't really in this market, more in the UK market, and I feel it's coming through a lot stronger. What role does ESG kind of play in for you in selecting your investment managers?
So we have a responsible investment survey that we produced earlier this year. We'd be really happy to share that with everyone. We interviewed all of our managers on their efforts towards responsible investment, and we graded them on the way in line with the UNPRI, United Nations Principles of Responsible Investment, and the CRESA standards and the King IV codes. And we assessed them on how they're doing, and we gave them some targets or objectives to areas they can improve on. And generally, no one was great everywhere. Some people were good in certain areas, and some people were good in the proxy voting and following up on their votes and questioning company management on those votes. Other people were better in terms of applying environmental or a social or a governance lens towards the way they research stocks. So it's really mixed bag, and it's varied. It's not unique to South Africa. All over the world, they're struggling with this. It's a huge, vast new set of information that investment managers need to take into account. I mean, if you think about the Sustainable Development Goals. There's 17 of them, and below that there's 253 measures. So you can imagine if an investment manager, no matter what size you are, is going to try and tackle all of those and grade their portfolio, you're not going to invest in anything, because you
still need to perform. You still need to choose stocks that are going to perform for you, and that's
So the thing I looked at this a while ago, and there's ESG is not new. Stewardship funds are not new. They've been around since the 80s, but I think the earliest one was 78, 79. It never really had any traction. And the reason being is because as soon as you constrain a portfolio, you're tying your hands behind your back. So for example, if you can't own oil stocks when the oil price is running and you underperform, and then people like to be ethical until it affects their money or their financial situation. And we saw this through time for many, many years. What's different this time is responsible investment lens says, rather than disinvesting, engage with company management and say, we're forcing you to do this. I'm a shareholder. I have a voice. And the more people collaborate and come together, there's been a great collaboration by a few of our managers and other managers in the SA universe to promote the eradication of plastic through the supermarkets. And people on the street don't hear about this. Wealth managers don't hear about this, but it's something that is going on behind the scenes, because they have the power from their end investors, capital, to collate this voice just based on the number of shares that they're holding, to force company management to make a change. It may take time, but it's a start, right?
But it's very interesting. So one thing, do you feel ESG is becoming more prominent though? So you did the survey, beginning of this year. If you do it at the beginning of next year or in 2 years' time, do you think the results would be better potentially?
Yes, absolutely do. And we're already seeing it. I mean, just by engaging with some managers, they recognize that they're either behind the curve or they have areas of improvement. And it's funny because, one of the things that was obvious is they're still competitive even in this space. So if they don't score well, then they're saying, who's the guy that scored the best? How can I catch up with him? And and obviously, a lot of our global managers are being forced to do this, or have been forced to do this for some time now. They've been looking to win institutional mandates in Europe, who's the leader in this space. They've had to embed ESG considerations within the way they run money for a number of years. So it's more prevalent outside of South Africa. Demand for it isn't as strong as it perhaps should be. And so what we are seeing is some of the in the institutional space, there's much more acknowledgement that this is an issue, and they want to push on ESG factors within investing. Within the retail space, I'm constantly talking with advisors, wealth managers, about whether they're getting requests for this from their end investors, and that's really not coming through just yet.
No.
But the more people talk about it, the more people hear about it, the more pandemics or earthquakes we might have, or climate-related events that we might have, people start to ask more questions. And the other thing that people don't realize is they should have a voice within their pension fund as well. So we put a load of money into our pension fund, it goes away, people just think it's gaining more money for them or earning interest over time.
Hopefully.
But they don't realize that they should have a voice through that fund manager to the companies that they're investing in.
Yeah, it's actually got a question now just from the audience, and it's on ESG, so it's appropriate. Will ESG translate into better returns for investors?
So that's $1 million question, isn't it? And every ESG or sustainability manager will put up the last 10 years and say, look, we've outperformed. And the part of the reason for that is because a lot of the clean companies, the tech companies, so what's underperformed? Oil, mining, until recently, tobacco. These are the areas that, and even defense. have been really lagging the tech businesses, and that's what's been driving the market. And so that's why sustainability or ESG related strategies have been riding that wave, perhaps unintentionally. Will that continue into the future? It could. I mean, if what I expect to happen is that I expect the dirty companies to become cleaner over time. And you see it everywhere. You see in the oil companies advertising their renewables programs. You see the miners advertising their welfare of their employees, or the community social involvement that they're having in the communities around their mines. That's being more and more promoted. And so all of this, the questions that they're getting is forcing company management. Company management are changing as well. They don't want to be the bad guy running a business that's giving the climate, the social inequality, any of the SDG factors that have been identified for a better future. Company management don't want to be the ones that are driving that through their business.
Yeah, but also I suppose you say it's maybe it's, you know, if there's a good company, it'll still be a good company, it'll still produce. And it talks to almost your earlier point of, but now actually what happens is the shareholders putting pressure on the company to make some good changes. So plastic bags versus paper bags is an example. But they still like the company. Which I think is so again, as you said, it's the way ESG is potentially being kind of managed now versus in the past is quite different. So another question come through, which is a goodie, I think. Are your best of breed partners more value or growth focused? Is value investing dead?
That is a great question, and it's been asked a number of times. I'm going to answer that by avoiding it. And the reason being is because I think the differentiation between growth and value is misunderstood. So a growth manager is by definition constrained to companies that are growing their earnings. A value manager can invest in the entire universe, but will only buy growth companies if he thinks they're offering value. Does that make sense? So remember earlier I said ESG puts a constraint on your universe, and that means you're fighting behind your back. People tend to think that value investors are the ones fighting with a hand behind back, but actually the opposite is true, where growth managers aren't going to look at tobacco companies, oil companies, supermarkets, banks that are offering incredible value, because they're not offering the size of growth that they're expected to produce for their end investors. It's a growth strategy. So that's my lens. So as a value investor, you can buy growth companies if your definition of value is that your future earnings that you expect from this business with a certain level of certainty or visibility or transparency over those earnings, and you can pay less for them now if you discount back to today than you think they're worth. That's true value investing. Generally, I think most fund managers have a value lens to the way. Otherwise, you're trading on the momentum of a growth stock. Is Tesla a value investment? Probably not, because I think it's been bid up so significantly by individual investors wanting to ride the wave, and so that would be a very difficult stock to hold for a value investor. But then again, if you are using momentum as a strategy, I liken it to if you're going towards a green light at traffic lights. If you're driving on a road towards a green light, do you accelerate knowing that you've seen that green light and it's been green for a while? So do you accelerate to try and go through, or do you slow down and cover the brake because you think that it's going to turn red?
Well, if it's going to go orange, you definitely accelerate to get through.
Well,
in this country, in this country, is no doubt about it. When we see it, we put foot. Yeah. So just another question's come through, but I'm going to look at it now. One thing also is very topical at the moment is kind of offshore investing. So again, we've seen, we see it in our space, a lot of clients now taking money offshore, and speaking to some wealth managers, they reckon about 70% of their kind of client investments now, the need is to go offshore. And something we spoke about yesterday in our catch up was, actually is actually your access to information with webinars and that is now tremendous, and that you've got so much information coming through. I mean, does your approach differ for kind of your global strategies versus your local strategies?
Each strategy differs. So even if it's within our local range, the way we approach assessing a multi-asset low income strategy, or assessing an SA equity strategy, that's going to be different. So by definition, yes, local versus global will definitely be different. The process or the process of the approach to selecting a manager doesn't change. Generally, what we like to do is we'll define the strategy that we're looking to offer, and what are the key elements that you want to see in a fund manager for that to be successful. And if you map that out even before you start looking around the internet or your investment tools, or that really helps you have an idea of what's the definition of a successful manager in a particular strategy. And for our Global Emerging Markets Fund that we launched just over a year ago, we did that at the start. So we looked at all the strategies on offer. We looked at ones that had been successful through time, either consistently or at certain periods, and what were the attributes of those fund managers that translated into strong performance. And the one thing that we identified that consistently performing managers had were country assessment, as well as bottom-up stock picking within emerging markets. And so that was something very specific that we went and looked for in our search for a manager, what their top-down view of a country's dynamics were. Because if the country's currency, inflation, growth were all poor, then if you held the best company in that country, it didn't matter, because people didn't want to invest there. And so that's a very specific view that we had for that particular search. And so, yes, the other thing, I guess, is you're unconstrained when you're looking in the global universe, because you can look everywhere. And we looked at managers in Chile, in Korea, in Spain, in the UK. We actually selected a manager from the UK, believe it or not, the US, Canada, for a global emerging market search. We assessed the local managers for that search as well, because you think, an emerging market strategy should be run from emerging market. But we didn't find any that we thought were as strong as the one we did. But it's your ability to scour that entire globe, which is different.
Again, something we spoke about yesterday is because you're not from South Africa, you've actually got quite a different view or perspective on our country, probably than locals like myself. And I think it's worthwhile chatting about that, because again, we read a lot of the kind of negative press, the art of Twitter. 140 characters, whatever it is, everything's bad. And it's not, I'm not saying it's good, but your perspective of that is slightly different than a lot of the kind of the local guys.
Yeah, it definitely is. The thing that really drew it out for me is I came here with the family in 2006, just after Brexit. I remember waking up in the UK. We went to vote against Brexit, and the result came through in the radio in the morning. And my wife and I, we couldn't believe it. It was just, we think it's a terrible backward decision. And the country was so divided. It was 50-50, and just obviously Brexit won. And then we moved here, and we'd just gone through the municipal elections here, where the DA had won a load of municipalities, and it looked like there was a road to a better future for South Africa at that point in time. And then we had the good to leaks and corruption started out. I mean, if you'd said to someone, do you think you'll hear a radio advert, anti-corruption radio advert in South Africa a year ago? Do you think anyone would have said, no, it's quashed by the government? But now we're hearing it every day. I hear it on the radio, anti-corruption. And I think the thing that people, this isn't unique to South Africa. It happens all over the world. There's issues going on in every single country. You look at Brazil, you look at Russia, the way the governments are handling there. Look at China's the poster child of the emerging markets at the moment, but then they put a crackdown on gaming that affects Tencent. And you think, well, what's the rationale behind that? And how is that working? And then did they hide the original effects of the pandemic in China? And so there's issues everywhere. And Italy's another great example. I love to bash the UK and people say that I do that too much, but Italy's another great example. I mean, the corruption in the government there was horrendous before you got rid of Berlusconi. And I'm not saying it's any better now because I'm not an expert there, but it does happen all over the world, and there's issues everywhere. And I think, for me, there's so much going for South Africa in that most of the people in this country want it to work and they have a voice through democracy, through the various channels, through protests, through there are avenues to stop the problems here, and there is so much good about it. I think the one big thing that is stifling us at the moment is investment, capital investment, or fixed capital investment. And until you see corporates and foreigners putting money to work here, that's going to hinder the growth and hinder the ability for the country to grow again. So I'm tentatively saying that this situation might be a good thing, in that some of the state-owned enterprises, we can't afford to support them anymore. We might have to curtail the spending on those, and actually maybe that money will go where it's meant to go and start improving our ability to turn things around. So I'm hopeful.
Yeah. Now, I mean, I'm also an optimist, but I mean, and maybe overly positive, and I often get told that by my friends and family. But it is refreshing to hear that. Again, I'm not saying anything's rosy here, by no means. But again, the grass isn't necessarily greener either. And I like your comment on there are a lot of good people trying to do the right thing. But I know there are a lot of different viewpoints on this, and we're not going to get into it now. Another question from the audience: how does the UK investment market compare to the SA investment market?
That's a good question. I guess there's more diversity there in terms of its exposure around the world. You've got, it's similar in certain ways. So you've got probably 50% of the earnings of the FTSE 100 are overseas, if not more. And so we have that in SA now. I think we're getting on for 60% of the JSEs. The Aussie earnings are offshore as well. The UK market is looking cheap, but so is the SA market at the moment. The UK market, the problem I have there is that there's not a lot of investment there either at the moment because of what's hanging over the Brexit conundrum. So it's probably going to be a no deal. If it is a no deal, what impact does that have on the ability or the appetite for businesses to carry on investing in headquarters or teams of people in the UK? It's an expensive place to employ people. All of the countries in Europe that can repatriate some jobs are doing that. So we see Deutsche were cutting some significant jobs in London, and they're repatriating jobs to Germany. And so I don't think at this point in time, it's a great place to invest broad based. There might be some fantastic opportunities there within some of the companies, and I'd love to tell you all to go and buy Vodafone for an obvious reason.
yeah. I was sorry, it came back to the topic, which again is kind of about your investment approach. Is it again a question comes through? What are the key factors you look for in a manager, and what do you think advisors should be focusing on when selecting managers?
Yeah, that's a great question. I think my one thing, if there's one thing that I look for when I talk to a manager, it's his ability and willingness to think differently. Imagine how much information you're getting into your inbox every day from various sources, and the webinars you can join. It's an overload. And so effectively everybody has the same access to the same information. Otherwise you're insider. And that generally doesn't happen. So it's the ability to interpret that information differently to other people and see opportunities. And how you do that, or how you find managers who do that, is you ask them about some of the esoteric ideas within their portfolio, or so if someone's holding a much lower weight in NASPAs than the benchmark, or they're holding 0 in NASPAs, well, why is that? What are you seeing differently? And there's some candid answers. You get candid answers from a couple of our managers. We can't understand it because we can't see everything that's going on within Tencent, which is the bulk of the value there. And so it's someone with the humility to be able to say, I'm not going to invest there because I can't understand it thoroughly enough to be a convinced investor. But also, and we think we've got great ideas elsewhere. And what are those great ideas? There's my example that I've used many times of guys that think differently is that I used to hold a UK manager in my portfolios in the UK, where he said he used to go to the supermarket with his wife, and he used to be snooping around other people's trolleys, looking at what they were buying and seeing what was popular, and seeing trends in brands and things like that, or brands versus own label in supermarkets and things like that. And it's whether that fed into his thought process of whether to buy Sainsbury's or Tesco's or own label versus brands. And eventually she stopped taking him to the supermarket because it was too embarrassing for her. But it's doing something different like that. Managers recognize that they need to gain an edge, and they won't get that by sitting at their desk number crunching. Or
it's interesting. So I mean, it's Keelan Glover, who runs the Standard Property Fund. One of the key things he always does is he goes to the shopping malls. He goes and it's right. So absolutely you can look at you can get the foot count numbers coming through, but he wants to get a sense and a feel of. I remember talking once about one of the malls. I think it was in Soweto. I can't remember. And the queues outside the door of the ShopRite, then he knew this place is pumping. And again, it's interesting. So he's not just about the stats and the reports. Gets himself out there to get a real feel for it. And I think property might be slightly different and then easier to do that. But I like your story on the guy looking at it in the shopping trolleys. I mean, my wife does it anyway, and she's not an investment manager. She's just nosy. Another thing that comes through is that. So what disciplines do you have that you kind of don't overreact with in terms of when you're holding a manager, maybe they've underperformed, or there's a lot of noise about them in the market, or even just noise about some of the stocks that they're holding. Like, what disciplines have you got so you almost don't overreact, that you keep holding because you still see kind of the long-term growth coming through?
Yeah, that is a good question. So I'd love to say that we are always in front of these questions or these or the issues, because I think we've got a number of processes in place where we can identify problems that may be coming. Performance is just one element, because it is always backward looking, and it might be that the environment that we've just experienced hasn't been favorable for the manager's strategy or where he was investing, or it didn't play out. His thesis for the market or the companies he was invested in didn't play out. And as long as you've got a diversified portfolio, hopefully that won't carry you out or lose the end clients a lot of money. What you do want then, though, is you want to make sure that you go in and you test that if has something changed. And so that's the key thing to remember, is like looking for where things have changed. Has there been team changeover? Has there been a change of roles for any of the, so has one of the portfolio managers been made head of research, or has he been made the CIO, or is the CIO now taking on the CEO responsibilities? Has there been any employment issues where they might have taken their eyes away from investing? Are there any corporate issues happening? There's various elements that you need to be testing on an ongoing basis to see that they're at their desk running money, and focused on the end outcome for the end investor. And that culture is a big one. I think, do people want to work there? And you don't get that from talking to the main people at the firm. You get that by talking to the receptionist. You get that by talking to the investment analysts on the team. Try and talk to the investment analysts without the PM in the room, because you get a more candid conversation, and it stops the portfolio manager trying to dominate as well, which is always tough for the analyst to hear them, because what you want them to be able to do is to hear them voice their opinions on the stocks, either within the portfolio or not within the portfolio, and see how that ties in with the portfolio manager's application of that research. So they'll obviously
I suppose it also, as you said, kind of gets you get in their heads, understanding kind of what kind of ideas are they having, how do they differentiate themselves in terms of what you mentioned earlier.
Yes, exactly. And I think you have to give managers time. You have to test them on periods of performance, because you need to know, your end investors need to know, our wealth managers, advisors need to know what's going on. Should I be worried about this portfolio? And again, it's testing whether something's changed in the way the guy thinks about the investments that he has in his portfolio. And if that's at odds with what he told you in the first place, remember we chatted earlier, that's when you start to ring alarm bells and say, maybe he's questioning himself. Because I've also seen that happen to fund managers. They start to question themselves. They start to get less confidence, which means they start to take fewer bets away from the index they're trying to beat, or they start lower conviction in some of their holdings, which means their performance profile going forward isn't going to match what they've produced in the past that you expected or you selected them for. So yeah, it's always good to test the confidence of the manager. And
then traditionally, how long do you hold an investment manager for? What's the shortest period of time you've held someone, and then what's the longest?
Good. I mean, shortest probably without an influence of a significant change, probably going to be 3.5, 4 years. That again probably was instigated by. At Nedgroup Investments, we used Chartwell, George and Mark on our Global Cautious Fund, and we appointed the Killen Group. Then Robert Killen sold the business to Chartwell within a year of us appointing them. Then we went in and we really tested whether George and Mark, the portfolio managers, the drivers of this strategy, were going to be happy there, and it was a nice home for them to be able to run their investment strategy unencumbered by the business. And then 3 years later, it turned out that they weren't too happy with the structure of Chartwell, and they decided that they wanted to move on and go somewhere that they could retain an ownership of the success of that strategy. So that's what happened there. So that was probably 4 years. A lot of our strategies, I mentioned the guys at Electus. They were running our growth fund for 19 years. Ford's been running our stable fund since inception and our value fund. The guys at ABAX have been running the Rainmaker fund for I think 17 years now. So these are partnerships. We think we do the right amount of work up front to know that we selected the right partner, and then we're only going to change the manager on a fund if we think that either there's something that's changed or something that's going wrong with a particular manager, or we uncover something else that's brilliant and a new idea that we think our end investors will be served better by this, by the new idea. And I think we could, that's the constant challenge for us, is we can get comfortable, but we need to make sure that we're still looking out there or looking on testing whether this strategy that we originally selected is viable into the future.
Another, I think a good question coming through is, what would you sacrifice first, investment performance or investment principles? When do you tell your clients you've made a mistake? Very good question.
Wow.
Yeah. Unfortunately, I mean, I'd like to give the person credit, but they've come through as anonymous.
Right.
But yeah.
I'd like to think they go hand in hand. I don't know if anybody's read the book by Ray Dalio, Principles. I mean, it's an incredible piece of work in terms of how involved his principles, he's built his principle framework. But I think if you stick to your principles of investing and they are appropriate ones, then the performance should follow. I'll caveat that with the comment I made earlier, is that you need to have humility and flexibility in terms of when you know that you need to make a change, or you recognize that something's not working and you test whether you need to make a change. I think as soon as you sacrifice your investment principles, then you're more likely to underperform in the future. And I think that's certainly something that we would hold ourselves to in terms of principles. And the overriding principle that every fund manager should have on their list is that they're running other people's money, and it's not about the size of. If someone tells you, oh, but it's only a 0.1% position in my portfolio, and you say that's still 100,000, 1 million, 10 million rand worth of your portfolio, how can you say that? That's someone else's money that you're diminishing. And so that really actually gets me, that comment from fund managers, when they say that. It's still money that you could lose for that end client.
I'm sure that resonates very well with our audience, because exactly, I think often the comments that I not often, sometimes you hear the comments going exactly as the wealth manager's dealing with the end client, and the fund manager is almost removed, but actually, so it's such I'm sure that resonates very, very well. Okay, I'm aware of time, so we've got a few minutes left. So if you have any more questions from the audience, please post them. I've got one more question for you before we start thinking about wrapping up. Kind of, what are the two key things the wealth managers, the audience today, can take out of our conversation from your side, in the terms of kind of selecting investment managers?
Yeah, so one thing I used to tell my team in London, and also that I encourage for my guys here, is when you're coming with a conversation or a rationale for a decision or an investment thesis, don't come and talk about past performance, because we're always going to assume that you've done that. You know that that's either good or can tell the story that you want to tell. And actually, it has no impact on what's going to happen in the next 12, 36, 60 months. What you want to know is, why is this fund or strategy good for the next 5 years? Why should I be making a change to go forward? And is there a good reason to switch from who I have? Because as soon as you take that decision to switch from one manager to another, you are saying that I know this guy isn't going to do as well as this guy going forwards. And you don't. You never do.
No.
Because you don't know you don't know there's a COVID pandemic coming, and that can completely derail all of your investment thinking. And so that's one thing. So focus on the future and what's the best strategy to meet your objectives into the future. I also think, one thing I'd like people to think is there's not one way to run money. There's so many different ways for managers to apply their trade and do well. And even if you're thinking about passive index investing versus active, before you take that decision, is that the right thing for my end client, and are they doing it well? So there's different strategies. Be open to new ways of investing. My favorite fund in Europe was a quant fund, and it was really tough to want to understand, because these guys are really smart who build these models, but also it was just after a period where there had been a big blow up in quant strategies. I think it was at Alliance Bernstein. It was a fat finger era, and so it was really tough to get people to buy into that. But I went through the process and I listened, and it was a consistent outperformer, and the way they applied it. And so it was tough to push myself to continue to listen and investigate further. And then sorry, I'll add a third, if you don't mind.
No, of course.
And it's that kind of thing I've been trying to get across all along, is what has changed. So yes, performance might be poor, but what has changed from the time you made the decision to invest? Is there anything wrong? What can you say is different now to 1 year, 3 years ago when I took the decision to invest? Is there anything different? And what is that? And if there is something, then maybe yes, you do make the change. If not, you're probably best to hold your horses and stay invested.
Yeah, I think it's very, very useful. So I'm going to take one more question from the audience, and then I'm going to wrap up. And I think we get this question every time. I do wonder if it's the same person. What keeps you up at night?
Well, again, it really astounds me how much of other people's money we're responsible for. And as you said just now, Steve, is that when you talk to the end investors, you get to realize how much it hurts. And you talk to, I learned a lesson really early on in my career is my dad said to me, look, I want to earn some money to pay my golf fees next year, my golf club membership fees. So he gave me some money to invest, and I invested. So I was young here, so please give me a bit of leeway here. But I invested it in Amarindo Internet Fund in 1999, and yes, but my only saving grace really was that I also made an investment and lost loads of money as well. But it made me realize that once you have responsibility for someone else's money, then it really hurts them, and the feeling that you get from that is you don't want that to happen again. So I'm
sure that was a seriously good life lesson. Yeah. It's, okay, we are time is pretty much up, so I'm going to wrap up quickly. So first of all, Rob, thanks very much. Really do appreciate it. It's been great. I'm sure the audience really enjoyed it as well. So thanks for your time. We do appreciate it.
Absolute pleasure. Thank you for inviting me.
No, good man. And then just to the listeners in the audience, thanks very much to you guys. Thanks for the questions. I think they're really, really good, and we do appreciate your time. So thanks very much. Quickly, just the CPD process reminder, you'll get a thank you emailer with your CPD certificate if you were able to attend the entire session. If not, as I said, you can do a short assessment and watch the recording, and then you'll get your CPD certificate. Our next In the Room webinar is the 27th of October, so please look out for the invites for that one. And then lastly, I mean, if you're enjoying kind of all the things that Innate are putting out, please follow us on LinkedIn. We've got a lot of articles we put on there. All our webinars are posted on there, and a lot of really cool things. So thanks very much all, and appreciate it. And have a good rest of the week. Thanks, Rob. Thanks all. Cheers.
Thank you. Bye-bye.